You spend decades following the rules, maximizing contributions, investing carefully, and building a significant nest egg. But for Canadians with over $500,000 saved, this financial success triggers tax rules that claw back thousands of dollars in government benefits. Since your very first summer job, you've likely been told to never touch your RRSP until you absolutely have to. The goal has always been to defer taxes for as long as possible. If your savings exceed $700,000, that waiting game becomes a liability. Deferring those taxes doesn't eliminate the bill. It builds a tax bomb that waits until your 70s to detonate. Once you turn 72, the CRA legally requires you to convert that RRSP into a RIF. You are then forced to take mandatory minimum withdrawals, starting at 5.4% of the balance and increasing every year. Stacking these mandatory withdrawals on top of standard Canada pension plan and old age security benefits frequently pushes retirees into the high tax income brackets usually reserved for active professionals. By deferring withdrawals for decades, you concentrate your entire tax burden into a highly penalized window at the end of your life. That artificial spike in income triggers a specific threat to your baseline security, the old security clawback. The math is unforgiving. As of 2025 and 2026, the CRA begins reducing your benefits the moment your net income crosses roughly $93,000. For every single dollar you earn above that threshold, the government takes back 15 cents of your OAS benefit. If your mandatory RIF income pushes you to approximately $151,000, your entire OAS benefit, nearly $9,000 a year, is eliminated. You have to decide between following the standard wait until 72 advice and surrendering those benefits, or proactively triggering taxes now to preserve that government income later. Protecting your OAS is a mathematical exercise that requires you to stay out of the CRA's danger zone through strategic planning. The primary way to diffuse that age 72 tax bomb is the RRSP meltdown, a process of income smoothing. This involves deliberately withdrawing $50,000 to $70,000 annually from your RRSP, starting in your early 60s, long before the law requires it. Look at this comparison. By drawing down the account early, you shrink the balance, ensuring future mandatory RRIF payments sit safely below the OAS threshold. The trade-off is paying a 36% tax rate today, sacrificing a decade of tax-deferred compounding. It's a hard strategy to embrace because it requires you to write a significant check to the CRA before they even ask for it. But paying a predictable tax rate now acts as a firewall, protecting your lifetime OAS benefits from being seized later. To manage the cash generated by that meltdown, you need the TFSA shield. You funnel any RRSP funds you don't need for immediate living expenses directly into your tax-free savings account. This builds a tax-free reserve you can tap later for healthcare or travel. Because it's a TFSA, those withdrawals add $0 to the CRA's clawback calculation. The main constraint here is your available TFSA contribution room, which limits how much you can shield each year. For married couples, you can also use a micro-RIF spousal split to lower your household tax bracket. At age 65, you convert a small slice of your RRSP, roughly $100,000, into a RIF. Because RIF withdrawals at age 65 qualify as eligible pension income, you can legally split up to 50% with a lower earning spouse, instantly optimizing your tax brackets. Combined, these tactics transform dangerous RRSP dollars into invisible income, effectively hiding your wealth from the clawback formula. The final pillar of defense uses insurance to establish a guaranteed income floor and protect your estate from terminal taxes. Drawing down your savings early often triggers longevity risk, the fear that your resources will be frozen or depleted if you live into your 90s. You can mitigate this by purchasing a life annuity or an advanced life deferred annuity to cover your baseline living expenses. These provide a guaranteed lifetime paycheck that remains completely unaffected by market volatility or economic crashes. The trade-off is liquidity. Once you purchase the annuity, that capital is no longer available for spontaneous large purchases. To protect the remainder of your estate, you can utilize life insurance as a tax offset tool. At death, your remaining RRSP balance is taxed as ordinary income in a single year, potentially triggering a terminal tax bill over 50%. A life insurance payout provides the estate with tax-free cash to pay that bill, ensuring your heirs receive exactly what you intended. Establishing this insurance floor gives you the psychological freedom to keep the rest of your portfolio invested for growth. None of these strategies are universal. Applying the wrong tactic to your specific profile can actively sabotage your retirement. This matrix aligns these strategies with the financial realities of most Canadian retirees. The heavyweight, with over $700,000 in RRSPs, should prioritize the RRSP meltdown and life insurance to survive the terminal tax hit. The optimizer, projecting income near $100,000, needs the micro-RIF split and TFSA shield to dodge the OAS clawback. And the security seeker should look at annuities to lock in their baseline expenses and eliminate the fear of market downturns. The Canadian tax code silently penalizes passive behavior. In this system, doing nothing is a choice to pay the highest possible rate. You need proactive, fee-only planning. The CRA will not issue a warning before they begin reducing your OAS benefits. A truly secure retirement depends on engineering exactly when, where, and how your money is taxed, rather than simply accumulating a large savings balance.